This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. Over the next hour, we'll explore the changes to the Commodity and Crop Insurance Program in the One Big Beautiful Bill Act. Jonathan Coppess, Nick Paulson, and Gary Schnitkey, agricultural economist here on the Urbana-Champaign campus of the University of Illinois. We'll begin with Nick Paulson. Thank you, Nick, for being with us today. You're going to start with the changes to the commodity programs, more commonly known as ARC and PLC. Tell me about them.
That's right, Todd. Thanks for the introduction, as always. We're going to start off with me covering some of the ARC and PLC changes here. And we're going to start in that section with the changes made to the PLC, or Price Loss Coverage Program. And so one of the changes made to the PLC program was on the statutory reference prices. And here we're highlighting the changes to the commodities most relevant for Illinois and most Midwest producers, with the current and increased statutory reference prices for corn, soybeans, and wheat. And so we saw an increase for corn from the current statutory reference price at $3.70 up 40 cents or 11% to $4.10. Soybeans, a $1.60 increase to $10, and wheat's an 85-cent per bushel increase from $5.50 up to $6.35. Now, all of the program commodities, I believe, did see a statutory reference price increase. And so we've included a few of the percentage increases in some of those prices for some of the other bigger commodities here. So you can see that barley and oats were basically up 10%, sorghum up 11%, seed cotton an increase of 14%, peanuts up 18%, and rice up 21%. Again, all of the current program crops did see an increase in the reference price. And then the other provision here is they're building in some 0.5%, that's 0.5% annual increases that won't kick in until 2031 and will be subject to some limitations, but kind of building in an automatic increase in these, a small automatic increase in these statutory reference prices. But again, that doesn't start until 2031. The next thing we're going to cover here is changes to how the effective reference price is calculated each year. So again, the effective reference price in any given year is what matters in terms of the price levels that would trigger a PLC payment for each commodity. If their marketing year average price for that time period falls below that effective reference price. And so the effective reference price is going to be calculated now as 88% of the 5-year Olympic average of the most recently completed crop years. And so we'll see what that looks like here for 2025 in a second. But the change here is an increase in that percentage that's applied to the Olympic average of the most recent completed 5 years. So for 2025, we're looking at the 2019 to 2023 time period. And that effective reference price cannot be any lower than the statutory reference price, and it can't be any higher than 15% or 1 point above or 1.15 of that statutory reference price. And that effective, that 88% of the average, if it falls below, in between those two bounds, that's what the effective reference price is. So again, an increase here from 85% to 88% in terms of how that calculation. All right, next slide. Wanted to give you a feel for kind of how those updated or increased effective reference price calculations might compare to the current provisions, current Farm Bill. Again, it will tend to result in a higher effective reference price under the Big Beautiful Bill Act relative to the 2018 Farm Bill. And so for 2025, these numbers are set. Have completed that 2023 marketing year, which is the last year that's built into that 5-year Olympic average. And so under the 2018 Farm Bill, or what was previously current law, we would have had a $4.26 effective reference price for corn, Under the One Big Beautiful Bill Act, that increases to $4.42 as a result of that higher percentage in the effective reference price calculation. If we look ahead, assuming marketing year average prices for corn stay in that 420 range, if we look at what 2026, 2027, 2028 would look like, these can and will change based on what our actual marketing year average prices are for 24 and 25 and so on. But if we look at that 420 level out over the next 3 years, we see that effective reference price for corn would kind of be on a path down back to the statutory level by 2027, but higher levels under that One Big Beautiful Bill Act, again, because of that 88% versus the 85% that is used in that 5-year average calculation for the effective reference price. So basically for corn, we'd be kind of moving back down to a 410 level. The higher prices we experienced in 21, 22 are still impacting and causing that escalator provision, that 5-year average, to determine the effective reference price. And then we're going back down to that statutory level, but the statutory level is now higher at 410 instead of 370. All right, next up is a look at what soybeans would look like. And here this is based on kind of a 10-10, which is the latest WASDE forecast for the 2025 marketing year. Assuming that price level holds over the next 3 years, this is where the effective reference price would be for soybeans under the 2018 Farm Bill provisions in orange versus the increase in the One Big Beautiful Bill Act. And so 966 under the 2018 Farm Bill versus 1071 for 2025. And then again, both would be moving down back towards that statutory level, but we've got a new higher statutory level of $10 versus the 840 in the 2018 Farm Bill. And so similar patterns here, but again, the higher statutory and the higher percentage applied to that 5-year average results in higher effective reference prices under the Reconciliation Act. I don't know how we should refer to this thing. One Big Beautiful Bill is a lot of words to say over. All right, Ark County was also, I guess, improved in increasing the likelihood of payments being triggered and the size of those payments under certain conditions. And so current law, or I guess previous law at this point, 2018 Farm Bill, Ark County is that county-based revenue program that triggers payments when actual county revenue falls below 86% of a county benchmark. There is a maximum payment band or range, and that's from 86% down to 76%, or a 10% payment range. The One Big Beautiful Bill Act increases that guarantee trigger to 90% and expands the size of the payment range to 12%. So Ark County is now covering 90% down to 78% of that county benchmark revenue. Also, we wanted to make sure to note that the PLC reference price changes, the increased statutory levels, the changes to the effective reference price calculation will also potentially impact ARC benchmark prices. Ultimately, ARC benchmark prices moving forward will be higher under the new Big Beautiful Bill Act provisions relative to what they would have been under 2018 Farm Bill. Ark County will continue to use trend adjustment for ARC benchmark yields, so no change there, but just want to note that those trend adjusted yields will still be used in the yield history to define the benchmark for each county on the yield side. And then another big change here that we want to highlight is your eligibility to use that supplemental coverage option, SCO, crop insurance program, which Gary's going to talk a little bit more about some additional changes to SCO later this morning. SCO eligibility is no longer going to be tied to your commodity program choice. So previously, if you had you had base on a farm enrolled in Ark County, you could not use SCO. You had to have the acres that you wanted to ensure with SCO be associated with base enrolled in PLC. Now that restriction is removed, and so you can use either commodity program, PLC or ARC, and those acres will be eligible regardless of your choice to insure with that supplemental coverage option. All right, a few other changes for 2025, since the enrollment decision was made back in the spring for 2025. Given the changes that were made, they are effective immediately for the 2025 crop year. And so what is going to happen for 2025 is you don't have to go back and update your enrollment choice. You're actually going to receive the higher of PLC or ARC County for 2025. So whichever program ends up triggering the bigger payment, of course, both programs could still trigger nothing for your individual farm case, but whatever program triggers the higher payment is what you will receive for 2025. Those payments wouldn't be made until October 2026, because remember, you have to wait till the marketing year ends, and that won't be for corn and soybeans until the end of August 2026. I had a few more things to say on that slide. Some other changes I wanted to mention related to payment limits. Those are increased from 125,000 per person or entity up to 155,000 per entity. And there are some exemptions built in here for some what they're referring to as qualified pass-through entities in the legislative text, which some examples of those are provided there. You guys change the slides on me?
On purpose.
All right. Okay, let me finish this up. There is a separate or additional limit built in for peanut base. And I was going to maybe have Jonathan comment a little bit on this, on these qualified pass-through entities, as well as some of the, I think there were a minor changes made on the AGI limits. Jonathan, you have anything to add on those?
Yeah, I mean, basically, you've got the basics of it, right? We're increasing the total payment limit by $30,000. What the qualified pass-through entity is an expansion of an existing loophole. So that loophole previously allowed joint ventures or general partnerships to basically increase the number of payment limits for the operation based on the number of partners in the operation. So if you had 5 partners in a general partnership, you got 5 payment limits. Now that's been expanded to allow for these liability shield type legal fictional entities like corporations and LLCs. So what you can do now is expand the number of payment limits based on the number of whatever members or shareholders or partners in the operation. So it's a similar provision, but it's been expanded completely to include these liability shield type operations like an S corp or an LLC. And again, if you have 10 members in an LLC, you get 10 of those $155,000 payment limits. And of course, you can also increase or double those with spouse and family members. So an individual payment limit is actually at least twice that, depending on the family arrangement. So your spouse would potentially qualify for an additional 155, and then you can just increase that from there, which is how we end up seeing some of these farm operations get millions of dollars in payments. The AGI is the same at $900,000 of a 3-year average. But now it's been changed so that if 75% of the farm's income is from farming, ranching, or silviculture, then that farm is exempt from the AGI, so you don't have to worry about it if you're predominantly in an agricultural operation. Your income's predominantly from that. And those are, I think, the only real changes in this component of the policy.
All right, thanks, Jonathan. And then, just to kind of give you a feel for, what some of these changes to ARC and PLC could result in, or what we're looking at in terms of what they might result in terms of increased support. Obviously, The changes result in higher reference prices for PLC, a higher trigger on those ARC counties, and potentially even higher guarantees based on some of the reference price changes that can impact the ARC program as well. And so Gary's led some articles that we put on FarmDoc a week ago or 2 weeks ago, and then we've got another one coming out today. Here's a table from article that was already published 2 weeks ago on July 8th. And you can see the increase in relative to 2018 Farm Bill design for these programs versus the One Big Beautiful Bill Act. And so, on corn, PLC basically doubles the expected payment from 24 to 50, close to doubles it for our county from 44 to 82. This is a McLean County, Illinois example. And on soybeans, looking at probably no payment on PLC with the old reference price provisions versus a $24 payment potentially for 2025 under the One Big Beautiful Bill Act, and a more than doubling in potential ARC County payments on soybean base for McLean County. So some pretty sizable increases here in expected payments, kind of that 15 to 25 or even $30 range in terms of $30+ per acre increase relative to the previous program design.
Hey, Nick.
Obviously, this will change if you're looking at higher or lower price expectations, but this is based on kind of a low $4 corn price, $4.10, low $10 soybean price for 2025. Will also vary based on your PLC program yields and by county, depending on your county's benchmark yields and benchmark revenues. Pretty sizable increases.
Yeah, Nick, I was just going to jump in as a reminder that the 2025 aspect is what we're showing on the screen. Farmers do not have to deal with this. They're going to get the higher payment, kind of the heads I win, tails I win situation. So you don't have to worry about the decisions you made on those base acres. The statute now provides that at least for the 2025 crop year, FSA will issue a payment that is the higher of ARC County or PLC on those.
And just to clarify, that is for only the 2025 year. After that, you have to make the decision. But this year, no matter what you've decided, you'll get the higher of the two.
That's correct, unless Congress steps in and decides to extend that provision further and continue that. But right now, it's just the 2025 crop year. The decision has already been made. You don't have to go back and change it. You don't have to go into FSA and deal with any of that.
The other thing about this is this would, given our calculations now, be a $65 payment. That would be received in October of 2026. The ARC PLC payment for 2025, which would be associated with the 2024 crop, is not going to be that large, and in many cases going to be close or zero, actually. So that's a year away, and it's so don't count that money yet in the checking account till October 2026.
Yeah, that's a good segue into the next slide. So, also in a recent article, we updated sort of how this would impact our return projections for 2025. Want to make sure it's clear here that for both the 2024 numbers and the 2025 numbers, both of which are still technically projections, since we're not even quite done with the 2024 marketing year yet. But this does include the ECAP payments, the Emergency Commodity Assistance Program payments that were authorized back in December for 2024 economic losses and probably received as early as late March or at some point in April if you filled out the application process or completed that application process with FSA. And then this has that $65, as Gary mentioned, roughly $65 projection for the ultimate ARC PLC payment for 2025 here. Even though ECAP was received in 2025 and those 2025 ARC PLC payments, if they occur like we currently project, won't be received until 2026. We are looking at those on an accrual basis and including those for the years that they are associated with here. And then, I think the main point that we want to make here is that return projections, we had negative average returns on cash rented farmland in central Illinois in 23. Even with ECAP, pretty sizable negative average returns projected for 2024. And even with this increased support in the commodity title with ARC and PLC changes, 2025 still projecting a fairly sizable negative return historically for that 2025 crop year as well. So this definitely helps. I mean, we'd be looking at more like a negative $85 average return without that ARC PLC or something in that area versus the negative $23 per acre projection you see here. But we're still, producers are still facing a price cost squeeze, even with this increased support, but definitely a sizable increase here with the changes in the One Big Beautiful Bill Act. All right, and then the last slide I'm going to cover here, I'm actually going to turn it back over to the guys in the studio. Want to highlight some of the work Jonathan's been leading on the Policy Design Lab and some of the visualization tools that are now up at the Policy Design Lab website. So you can kind of look at not only how these program changes might affect your specific county in Illinois or whatever state you're tuning in from, but compare that to some of the other crops and areas that we see across the country there. So with that, I'll let Jonathan maybe plug that. And I don't know if we're going to try to do a live demo here of the Policy Design Lab site.
Yeah, thanks, Nick. I first want to give a real big amount of credit to our PhD student, Enrique Monica, who designed the model with Gary's help, I think. Give Gary some credit here. But helped design this model. And then, again, great appreciation to the development team at the National Center for Supercomputing Applications here on campus, which turned Enrique's model and data work into the visualizations you will see if you go to this website. And what we've got in here, and we're showing the differences in payment rates projected over the course of the next 10 years. I do want to note that what we have in the model, or what the model is using right now, are the program design, the policy design provisions that were in the House passed version of this. We are in the process of updating it for some of the minor changes that were in the Senate passed and then the enacted version of reconciliation. So just kind of a quick note or caveat that this will be updated in the near future to reflect the actual changes in the law based on the final reconciliation text that was enacted. But it's pretty close. I mean, the changes between the two, the Senate largely took the House language and then made a few changes. One of them is that floor price, the artificial floor price the House put in for the corn base acres. If you paid attention to that strange little policy design issue, that's no longer in there. So maybe the biggest difference will be on PLC projections for corn base. But largely, these will stay the same. You can look at this crop by crop, year by year, in ARC County or PLC. So there's a lot of opportunity to analyze the programs, and we'll keep using that and updating it as we go. I don't know if we're going to try to do a live demo here. You're beyond my technological abilities, I think.
We can if you can run it. It's not hard, I don't believe. That's up to you, though. Want to try?
If we break everything, oh, look at that. Very nice.
How about that?
Okay. Well, here we are, except I can't control anything with this mouse. There it goes. We'll do just a very quick, right? You can go in here county by county. We've got details for that county in the map, year by year above, program crops. Again, the major ones are in there. We don't have all the program crops in there yet. You can jump between the 2018 version and the proposed version of the House. You can go from the payment rate to total payments.
Go hit proposed policy.
Yep.
Let me just see something.
Okay.
And then hit, let's do rice.
Well, you want rice?
So those are the proposed payments.
Those are weighted by all the program acres, base acres. So if we want to just look at rice, for example, here, we drop down to just rice. which is also a nice reminder of how limited in geographical scope this crop is.
Uh-huh.
And you can see those payment rates there. Is something you want to look at specifically?
No, just
the way the map changes. The other thing we would note for those who are interested, you can download the data and use it for your own kind of analysis and comparisons. And then what we have at the bottom, I just want to be real clear about this chart. Let's put all the crops back up. Sorry, this is a little bit slow and clunky. Here we go. And I blame user error on that part, not the website itself. I do want to note, because we've talked about this a couple times, the charts at the bottom are showing different years compared to above, and that's because of that timing shift we talked about. So a 2025 payment comes out in October of 2026, which is technically fiscal year 2027. So these align from 2025 crop year above to 2027 fiscal year below, and we're showing the projections. So this is kind of like mimicking the CBO, the Congressional Budget Office cost projections. And so this is our modeled attempt to show how much we think spending overall increases and by crop in this from the 2018 version to then this House proposal. We'll update this for the final statutory changes. But again, we've got that timing shift. So if you notice that the years here below the current and proposed, notice that we're off on those years a little bit, but the 10-year budget window is what we're using. So again, this is just a resource for people to explore and try to better understand how the policy design results in this sort of distribution of payments, payment rates, and so forth. And we'll have more on that as we go. Todd, I'm going to let you take us back to the slide so I don't break anything.
We'll do that. Just as a reminder that this is running off the NCSA, from the NCSA building on campus here. If you could take and click on the policy design lab with that. Back.
What am I
take your arrow down. Having to reach across here. There you go. Thank you. And so that building, is a giant computer. It's right across from the State Farm Center. So just to the west of the State Farm Center, across all the parking lots, you'll see a large building there. It has the largest cooling pipes for water that I have ever seen, because it is so hot within that building. I think those are 16-inch, if I remember correctly. They're just enormous, the amount of water that they're using to cool that facility. Okay, we might want to ask and answer a couple of questions that are available.
So we've had a number of questions as we've been going through this about SCO in 2025, and will it be available on ARC acres for 2025? And my answer is that I would doubt it, because you made the decision back in March 15th, and I don't see RMA letting you make that decision now, although you could talk to your appropriate legislator and mention that you didn't have that option and you would like that now. I doubt that will come to anything, but you can try.
Yeah, and I agree with Gary that our basic read on this is, because it's an insurance program in which you've paid premiums and the ratings are an issue, allowing farmers to add SCO after the fact would be an issue. But I want to be clear on one thing. As I looked at it, the statute itself, the language does not specify the year that I can tell. So I don't know if there is any flexibility. I think we have to wait on some guidance from USDA on how they're going to implement that provision. It would be, how should we say this, Gary? It would be unique to allow for an insurance decision to change in that manner well after the fact. I mean, we are definitely into the growing year. It's hard to imagine allowing an SCO revision, but I wouldn't say we're 100% certain that USDA will implement.
Then the next question is, will SCO changes be applicable to the fall 2026 crops, which will be wheat for our part of the world, and the deadline for that would be September 30th. And I would doubt it, but
Well, here we have our first disagreement.
All
I would
right.
imagine that if that's a 2026 crop, that then all of these changes apply. So it should be, but I'm not 100% certain how they're going to implement this. It isn't, let's be clear, this is an odd, there are many oddities about how these provisions will act because of the way in which we've gone through this, right? This is not our typical farm bill process. And so we have this coming through reconciliation in the middle of the year with these kind of changes with retroactive application. So we don't know. We don't have much experience with that in terms of how we've done policy in the past. So there is a lot of uncertainty around it. We would expect, I think, because it's the next crop year, that those would kick in. Some of that's going to depend on how quickly USDA is able to implement any of these provisions. So I'm not 100%, but I'm a little bit more, I would guess a little bit more on the side of the 2026 fall enrolled crops would be able to take advantage of having both SEO available for both ARC and PLC, but very likely be wrong.
No, I actually do think it'll be available for the spring crops, corn and soybean.
I think absolutely in the spring when we go through this next sign up and the next enrollment periods. Absolutely.
Not to defend the RMA, but it would they would have less than a month to implement that, and RMA does a pretty good job of bringing things out, and then they would have to communicate that to all their AIPs. So it would be a tough job, but we'll see.
Yeah,
ask them to delay the sign up.
As you were going through the policy design lab, somebody made note of the number of commodities that were in the list, and they were interested to know why it was such a limited number. I'm going to say there are 17 or 19.
There's 23 total covered commodities in the statute that all have base acres, and this includes a variety of oil seeds and so forth. We have started with the 6 major covered commodities that are like 96% of all base acres in the country. We're looking at trying to add things like barley and oats and some of the oil seeds. But again, this has been a really impressive work product by Enrique in terms of just the amount of data and calculations that go into the model. So, those updates we'd like to get to when we can, but I think we're going to first get the Senate provisions in and try to come back and add some of these other smaller base acreage crops. But yes, there are 23 total covered commodities.
Now, since you mentioned base acres, we should move on. I will remind folks that the TIA Center for Farmland Research, CoBank, Compeer Financial, Farm Credit Illinois, Belfast Growmark, Illinois Corn Growers, the Illinois Soybean Association, and John Deere are all supporters here of the FarmDoc project on campus, and we appreciate them very much. I believe that you're going to continue on with base acres, Jonathan?
Looks like I drew the short straw in terms of the policy discussion to have here. I note that, Gary, just for the record. All right, let's talk about this adding base acre provision. Somebody's going to have to move this thing through. I will start maybe with a broad caveat on this, which is it is an extraordinarily confusing provision or set of provisions. And so there is a significant amount of uncertainty about how FSA will implement this, and then from that, how it will actually operate. So what we're giving you is our best understanding based on the legislative text, but again, a big caveat that there's some real confusion in how this was written, and that also leaves a significant amount of flexibility. So FSA's decisions in the implementation process will be pretty critical. The other thing I want to sort of hit at the top on this first aspect, this is for landowners, obviously, because the base acres run with the land. So you have, in a cash rent situation, the payments go to the farmer, but the base acre decisions belong with the landowner unless you've got that arrangement with the landowner to allow you to make the decision on their behalf. And this is different, right? In the past, we had a base acre update in the 2002 Farm Bill. The 2014 Farm Bill provided for a base acre reallocation. This is neither of those. This is an addition of base acres. So it doesn't change your underlying base acre situation. You're not going to change the allocation and you're not updating base. What it does provide is a limited, and by limited, I mean 30 million potential new base acres, allows that to be added to the programs and the farms. So it doesn't impact existing base acres. the calculations where it gets a little bit fuzzy. And what it says is that from the average acres planted and prevented planted, as reported to FSA from 2019 to 2023, relative to what is current base acres. So if those planted acres, including prevent plant, are above current base acres, then you're eligible to add base acres. And again, this is a general in the Midwest and elsewhere. It's where you've got those where you're looking at a situation where you're planting above your base acres. You can now add those back in. I think we can jump to the next one here, Todd. Okay, so here's an example. Let's say the farm's got 100 acres and 80 base. So 100 planted, 80 base, 45 in corn, 35 in soybeans. The average has been 50 and 50 from 19 to 23. So that's our above. So we're planted above base at 50-50. This farm may, and we should probably highlight and emphasize the word may. This farm may be able to add up to 20 new base acres, equal to that 50-50 planting arrangement. We would think 10 of those would go into soybeans, 10 would go into corn, increasing your corn base from 45 to 55, and 10 would go into soybean base, increasing from 35 to 45. Now you're at your 100. Again, that's not guaranteed for multiple reasons, but based on our read of this calculation, this is what we'd be talking about. So the additional acres above current base split based on the planting split would be then added to the existing current base. And I think that's our best explanation of how that's going to work. Okay, complicating this a little bit further. Again, it's a 2019 to 2023 reported average, so these should have already been reported to FSA. All years are included, and it's both planted and prevented from being planted to the covered commodities for the program crops. Okay. I don't even know really how to explain this one. So we're using the lesser of 15% of the total acres on the FSA farm, or 2019 to 2023 average, all years included, of acres planted or prevent from being planted to eligible non-covered commodities. So we know there's a definition of eligible non-covered commodities, but Gary, what is this doing? This is adding.
So this is
additional acres.
This is going to add additional base acres on acres that were planted to cover crops, right? And
so you're eligible if your planted acres are above base.
Yep.
Then we have this as an additional part of the calculation for what you can add.
Yep. And this one is so you can add up to 15% of your total acres if you planted an eligible non-covered commodity. What that is, no one knows. Literally, no one knows. What we do know is that it isn't a covered commodity, obviously, and it isn't a tree, bush, vine, grass, or a pasture. It could be alfalfa.
Likely alfalfa.
Alfalfa, I suppose, although alfalfa isn't planted every year, so who knows?
Right.
So, and it will include cropland that is idle or fallow. So, what this is add 15% of your tillable acres outside the Midwest and Great Plains, or any place that doesn't grow a lot of covered commodities.
So this is, again, rather confusing and rather uncertain, and much of it up to the discretion of FSA and the secretary on how this gets implemented. Our expectation is that this is something like an alfalfa or, the fallowed acres to allow those to come into the calculation, because they would be neither planted or prevent planted in those years. That's likely what we're looking at. But again, you can tell just by our inability to understand it, there's a lot of
it could be sugar beet. It might be sugar beet.
Well,
It might be, could it be vegetables?
Potatoes.
Maybe. I mean, none of those would qualify as the eligible non-covered. So it's possible.
Did Nick say something?
What vegetable did you include in that list, Nick?
What's your favorite vegetable?
Corn.
Sweet corn. That's
Sweet
what
corn.
I thought you said.
Yeah.
Sweet corn, yeah.
Yeah, I mean, I think we're just going to have to wait and see what the USDA says in the regs for implementing this, because we don't have clarity on this part. But just know that this is a part of the calculation. For those of you in the Midwest, unlikely that this comes into play, given kind of how the crop rotations are here. We want to jump to the third rule. And finally, the third is that it somehow includes unassigned base acres, which are effectively unassigned generic base acres. And for those who remember this wonderful provision, generic base acres came about in 2014 when upland cotton was removed from the programs because of the World Trade Organization dispute with Brazil. When those were removed, all those upland cotton base acres went into generic base acres. Then in 2018, Congress created something called seed cotton and gave it base acres. That calculation left some of those old upland cotton base acres out of the program still. So again, our best understanding of this little phrase in this otherwise wonderfully confusing provision is that it would basically allow those farmers who have unassigned generic cotton base to pull those into the seed cotton program, seed cotton base acres for that program, and again increase the amount of payments going to cotton farmers because that is the general theme of policies.
So you'll be able to add base acre if some of those acreage categories are above current base acres, and that's our interpretation of what happens to generic base.
Right.
And then we'll allocate new base acres based on plantings from 2019 to 2023.
Right. Again, this is additive. This is not changing the underlying base. And then the other kicker, do you have the limit? There it is. Look at that graphic. That almost looks like AstroTurf.
Yeah.
The kicker then is that there is a 30 million new base acre cap, which means they'll have to prorate the additional acres for the programs. And how they do that again is up to USDA and is not provided for in the statute. So we don't know exactly how that allocation or that prorating will happen. We presume, right, Gary, that there's enough planted above base that would exceed 30 million. So they're going to have to prorate this in some form or fashion. Yep. So again, we got to wait and see what USDA says. We'll update as we know more. But everybody should kind of understand that don't expect the maximum additional base acre added to your farm. Expect this to be somewhere short of that maximum because we have to prorate across the country. Again, we apologize for not having all these things hammered out, but there's quite a bit of uncertainty left in the way that it's written in the statute.
And that's what FSA will be working on for the next while. So
we presume they'll be busy with this for some.
Yep. And we did have another question about the 2025 year. And if you took PLC and signed up for SCO, you will still get the higher of the PLC or ARC County payment for 2025. And if you're wondering if you signed up for ARC County and didn't have SCO, yeah, that's
an interesting outcome.
That's an interesting outcome. So let's turn now specifically to crop insurance. And there was a couple things in the Farm Bill, or excuse me, not the Farm Bill, the consolidation, reconciliation, one big beautiful bill act that did deal with crop insurance. And there's two provisions that we want to highlight today. The first is that the premium support on farm level crop insurance products, the bill does include an increase in premium support for basic and optional units. So you can see there for 85% that premium support will go up from 38% to 41%. The bill did not specifically mention enterprise and whole farm units. The statute does say that commensurate increases should be made to enterprise and whole farm units. What those are is anybody's guess. So one would expect the enterprise and whole farm unit subsidies to go up as well. So we will see how that plays out. But in general, what that will mean is that more of the premium will be paid by the federal government and less by the farmer themselves. The other big change was to supplemental coverage option. And what this one does is increase the premium support rate from 65%. So if you look at SCO currently, it's subsidized at a 65% rate. It will now be subsidized at an 80% rate, and it increases the coverage level from 86% to 90%. So currently, SCO is county coverage going from 86% down to the underlying RP, RP, and YP plan, and it will go from 90%. And one of the things that we would suggest is that every farmer should consider the revised SCO, which doesn't mean that it's a good policy, but you need to consider it. And let me just give you an example here. This is from McLean County, and SCO for corn in this example is $36 per acre. So $36 per acre is the total premium. Total premiums are set by our MA, supposedly, to reflect the expected payment from that crop insurance product over time. So over time, a farmer that buys in McLean County SCO for corn at 90% should expect to pay $7.20 and on average get back $28.80. So what this bill does is increase 86% to 90%, and then also increases the subsidy level. So that 720 is actually 20% of that $36, which means that $28.80 is 80% of the total premium. So over time, I mean, Illinois or McLean County farmers should expect an increase in payment. Our understanding would be that these subsidy increases would start until the 2026 year, not the 2025 years. And we had a question, is expected county yields determined for SCO and ECO? They are not released yet for 2026. That will happen for wheat here in the next August. And for corn and soybeans, they'll be released in December of next year, not next year, November of this year. So that's the example here. And so, paying $7 to on average net $28 seems like you should take it. But one of the things that we observe is that this hasn't happened in the Midwest. In Illinois in specific, we simulated if the supplemental coverage option had existed from 2015 to 2023, and what would have happened here. You can note here the reds mean that farmers paid in more than they received back, and this is non-irrigated corn. So you see that a lot of Illinois has negative numbers. Same with Iowa, Illinois, Ohio, and Indiana.
Two quick things on that. One, that's pretty standard with what we see from insurance overall, that many of these Midwestern areas are paying in more than they receive out. And also, just as a clarification, this is a simulation. If this is not anything actual, this is a simulation. If this change had been applied back in 2015
to 2020.
Right. So this would simulate what gives us a sense of what might happen with the changes going forward.
Yep. And here's what soybeans would look like. So it would be all negative for Ohio, Indiana, Illinois, and Iowa, and positive for the other parts of the state. We had a question that the expected yields seem too low. I would agree with you. The expected yields have not kept up for Illinois, Indiana, Ohio, and particular soybeans. I would also say that this is something that we need to keep an eye on because this is now a major income support program. So that should treat the Midwest and Illinois, quote unquote, fairly compared to other parts of the country. And in particular, if we look at stacks, that has worked well for cotton farmers, and so should SCO. So we have this question: is investment toward insurance better than direct payments to farmers? That's a good question. I would say not in the Midwest yet. And the other thing about direct payments is you didn't have to pay in for them. So there is that. And it seems like destroying the double SNAP dollars where eligible SNAP recipients got twice the aid to use at farmers market, thereby putting more money directly in farmers' hand. Well, that's gone. So, yeah, the politics of this we can see play out over time, I suppose. So,
yeah, and it's one of the things that I think, Gary, we've talked about. We've been discussing and trying to wrap our heads around with these changes to crop insurance on top of what we've seen in recent years is how much the insurance program is trending towards this kind of payment program, or acting much more like a payment program in Title I. But of course, it's not a Title I payment program because farmers are paying into it. And so what we are seeing is kind of a combination of those payments transferring both taxpayer funds in terms of the premium subsidy, but also farmer funds, in which farmers' portion of premium paid into it is transferring over to these high loss areas. And one of our concerns is that increasing SEO and driving more participation in SEO will magnify that situation and make it more and more like crop insurance as a direct payment program, similar to ARC and PLC, with the big exception that farmers pay a portion of that premium. And so we are transferring from farmer to farmer. And this raises questions for how it's rated and how RMA runs a program, and a lot to really work on, I think, should we ever revisit farm policy again in the future.
Well, I do have a follow-up question, because are we not scheduled to revisit the farm program in the fall or during the summer months at some point? Do you think that'll happen?
Everything here is extended through 2031, with one exception, which is the Conservation Reserve Program was not extended, so we don't know what happens there. I guess the other exception is the suspension of permanent wall. So Congress is going to have to do something about those, but in terms of revisiting a full farm bill after doing all of this.
But didn't G.T. Thompson mention that last week? I feel like he did.
I've seen talk in the press about skinny farm bills. Yes. What I presume they mean by that at most is extending suspension of permanent wall, maybe dealing with CRP, the Conservation Reserve Program, and some of the other authorizations that expire. But what we're talking about is, the things that have already been enacted into law, which are not likely to change anytime soon, given the complex politics and challenges, particularly the challenges after they cut SNAP by $200 billion to help offset some of these costs. So it's going to be very controversial and complicated to revisit these policies, particularly in the next month or two.
So just to summarize here, increase on ARC and PLC support will have higher reference prices, higher effective reference prices, ARC coverage in larger payment ranges. We had crop insurance changes, increase in subsidy rates for basic and optional units that may extend to enterprise unit, and increased subsidy rate and coverage level for SCO. There were large cuts to the nutrition program, right, Jonathan?
Yes, in the reconciliation legislation, there is about $200 billion over 10-year reduction to food assistance through the Supplemental Nutrition Assistance Program. A portion of that, about 60 to 70 billion of it, was then used to cover these increased payments, this increased crop insurance. And this is the only time we've seen that in the history of farm policy, in which we've cut food assistance to increase farm assistance. That's hugely controversial. It's part of the reason why it was in reconciliation instead of regular order. And that truly complicates, if not clouds, the future farm bill authorization efforts in significant ways. I'd also add that conservation was also reduced by about $2 billion over 10 years. Mostly that is a move of the Inflation Reduction Act conservation funding increases, moving them into the permanent baseline. And so there's a loss of about $2 billion in doing so, but we would presume if Congress doesn't cut those programs further in future efforts, that would eventually be made up over time. It just takes quite a few years to make that up. We're working on some analysis on that right now. So there's some pretty controversial aspects of this. Oh, right there it is.
I'm sorry.
No, you got ahead of the bullets. So that's kind of the big overview. There's increases in funding for the market development, for market access and foreign market development programs. Some other kind of items that were also funded through this, but there are also a significant amount of the authorizations in what would traditionally be a farm bill that have not been extended through 2031 the way these programs have. And that, I guess, leads to some of this talk about a skinny farm bill or some extension type effort. I would expect that to be very limited.
I'll let these folks take a quick look at what else is available to answer his questions and remind you that we have some sponsors. They include the TIA Center for Farmland Research, CoBank, Compeer Financial, Farm Credit Illinois, Growmark, the Illinois Corn Growers Association, the Illinois Soybean Association, and John Deere. We've been joined on this FarmDoc daily webinar by Jonathan Coppess, Nick Paulson, and Gary Schnitkey, our educational partners, of course, at the College of Agricultural, Consumer, and Environmental Sciences, right here on the campus of the U of I, the Department of Agricultural and Consumer Economics, Illinois Extension, FBFM, and the Gardner Agricultural Policy Program. Remember that you can always find these programs anytime you'd like at farmdocdaily.illinois.edu. Look under webinars and you'll be able to find an archive of this one. Better yet, you can go to YouTube at youtube.com/@FarmDoc. Find us on Facebook and X as well. Anything else that you see that we should answer before we go, Gary?
So
John.
Yeah, what's the clarification? Please clarify on the AGI. Limit. So, right, AGI does not apply in the future, right? Once this is implemented. So let's not mix up our time frame. But basically, if 75% of the total adjusted gross income is attributable to farming, that's farming, ranching, silviculture, then those operations are exempted from the AGI limit. But that is only commodity title programs, commodity title programs, loans, and conservation. It is not there are no AGI provisions in terms of crop insurance. The ECAP, that's already gone out, and that just, I think that had the same kind of provision in it. So I think that is what you'll see under the ECAP provision. I'd have to double check that, but I do believe it included that AGI exception. Hopefully that clarifies a never quite clear policy.
Yeah, but we had a question of whether we will be able to update the PLC yields, and the answer is no. Those will remain fixed. So another question has come in about ECO and what will happen to ECO. And ECO for 2025 or this year ran from either 90 or 95% down to 86%, which was the beginning of the old SCO. Well, SCO now goes from 86 to 90%. So there are going to have to be revisions made to ECO. And I don't know what those revisions will be. I suspect there will be an ECO from 95 to 90%, but I don't know that. So we'll wait and see on that. And again, those are private products, so the developer will have to make some changes to that.
Quick question on ARC IC, the individual coverage option in the ARC program. That should continue to be an option. We haven't talked about it a lot. There weren't really any changes to it. And it's not been used a lot given the pretty significant penalty on base acres for the payments. But yes, that is also extended as part of the 2031 like ARC County.
And did the subsidy increase for optional and basic units make it to the final legislation? Yes, it did. And again, we showed those earlier, and so yes, it did. Do the subsidy increases for SEO apply to the 25 crop year? No. And will it start in 2026? Yes.
Yeah, I think the question there is on the fall planted crops if they get things implemented. But yeah, the 2026 crop year insurance year was.
In your base acre example, you showed 45 base acres of corn, average corn plantings of 50, but then being able to add 10 base acres of corn. Yes, that is correct. Yes, it is. It's adding base acres. It's adding base acres based on what you planted. The old base acres do not change. So,
right, the old base acres do not impact that additional calculation. So I think the way, if I'm reading this correctly, it's not up to 50, right? What we're talking about is you've got 20 you got 20 acres planted above base, and it's that 20 above base that the split applies to. So the 50-50 applies. That's how we got to the 10.
So is there hope that RMA will re-rate soybeans and corn so that actual payout versus income is 1-to-1 instead of less than 1-to-1? You can always have hope.
Remind them what that ratio is.
So the loss ratio is legislatively mandated to equal 1 over time, and with a small loss reserve, it does actually do that across the U.S. It, unfortunately,
because of
soybeans and corn. So if you re-rate corn and soybeans, you also have to re-rate everything else. So, and by the way, those issues were not, and let's say that again, were not addressed in the reconciliation bill.
Right, that's correct. But just to emphasize that point, there's nothing in the reconciliation bill requiring any kind of re-rating or changes in ratings. So that remains at RMA's discretion and how they operate the program.
Yeah, and we've sort of covered this, but this is an explicit question here. If SCO coverage goes from base farm coverage to 90%, does that effectively mean that ECO 90%, which has 86 to 90, is moot? And I would, yes. So they're going to have to do something with ECO. What they do again with that is a good question, because you're right. ECO goes from 90 to 86%, and that band will now be covered by SCO, and they're not going to allow you to double cover that band. So we'll see what they did. What's going on with margin coverage option? Is that still going to be a thing? And yeah, it's still going to be there. There's nothing in this farm bill that's changing that. So yeah. So we've gotten a number of questions about SCO in 2025, and if you took our county and we're unallowed to SCO, your official answer is you're probably not going to get it. And
right, we see. So let's be clear. One, there's nothing in the statutory provisions from the reconciliation bill that would change that SCO operation for 2025. We think it's highly unlikely that RMA or USDA will make a change to an insurance program that's already in operation for a crop already growing. So we presume that the hire of the Ark County PLC payment will happen without any changes to SCO. So to Gary's point, if you took Ark County, you were ineligible for 2025 SCO. We presume that continues, and you will not get SCO even if PLC is the higher payment on those base acres, because of the difference in crop insurance and commodity title program payments. At least for now, it seems unlikely we would go that extra step and then upend what could potentially be some significant payments out of SCO for those that did not sign up or pay for it. Again, another question asking about paying premium. We would assume you don't have to pay for premium if you don't have SCO, where you selected Ark County and were ineligible for SCO.
Yep,
so presume for now, until we hear differently from USDA, that SCO stands as the decision was made in March, and only the Ark County PLC payments will change depending on which is the higher at the end of that marketing year and into October of 26. That is our presumption until we hear differently from FSA or USDA and RMA. That is our presumption. I don't know that there's anything else we can provide on that at this point in time, but we will certainly update if we get information on that.
Okay, we have expired our time, although I'm going to take just a little bit more because I want to know from the three of you what you think the most important takeaways for the moment are for producers. I'm going to guess that the very first one is that they are now signed up essentially for both ARC and PLC across the board, and whichever one is the higher paying of the two will be their payment on this year's crop, but that won't come until the fall of 2026. Gary, what else?
So yeah, that's exactly right, Todd. And really, you don't have to make any decisions now. So you don't have to make any decisions now. Actually, I think the biggest change in this farm bill is one that is the SCL, going from 90% down to the coverage level and the 80%. You're effectively adding a farm program with no debate, and if it's rated properly, there's going to be large amounts of funds going out. You're also going to have to think about what this means in risky areas, because you're going to subsidize riskier crops in riskier areas more. And if you have a choice between a risky crop and a non-risky crop, the decision is now tied to planted acres. So the crop insurance payout could come into that decision. And we've generally tried to avoid that.
Nick, from your remote spot, what were you following along, and what do you think are the most important things for a producer to recall? SEO, which we've heard about, the decision that doesn't need to be made this fall for payment. What else?
Yeah, I think Gary's points are the big ones for Midwest producers in terms of like practical steps, decision making, whether it's needed now or later. I think some bigger picture stuff, and Jonathan can elaborate further on this, is just, again, where this puts the farm bill moving forward. Some of the differential, everybody's getting something more out of it in terms of higher reference prices, maybe adding some base acres. But, the relative increases vary quite a bit across commodities, which vary by region, and I think that's an important thing to monitor from a Midwest producer's perspective. It's kind of amplifying some of those differences that we've seen historically.
To be clear, not everybody is getting something out of this bill, because it did decouple, relatively speaking, the food and feeding programs, and they ended up with a loss, usually part of the farm bill. So that has changed. That's a difference. And anything from the base acres that you think is most important?
No, I mean, I agree with Nick and Gary on this, which I try not to do very often. I think particularly Nick's point about the really big picture, and to Todd's point, I think we are entering a new era of some form or fashion in farm bill policy, farm bill history. While they didn't technically decouple SNAP and payments, I mean, the fact that we took $60 to $70 billion from food assistance to pay for these increases that are also drastically tilted towards one regional set of crops really complicates the politics going forward. If I were to say one thing in this that jumps out at me that I'm still trying to wrap my head around, it's this qualified pass-through entity and what it might mean in reality. I think it's one of those things where, forming an LLC is a business decision, but this is written as a loophole in payment limits, which means as those farms are able to increase payments, then you're likely to see those farms go out and compete for cash rent and drive up cash rents and land prices locally and get bigger and bigger. So I'm worried that provision could very well be an accelerator to the consolidation trends we've seen, with real implications for farmers, beginning farmers, younger farmers, and rural communities. That was not really considered, debated, deliberated, or otherwise analyzed before it was put into law. So I think that's a big concern as well, but we'll have to wait and see how that plays out.
Our thanks go, of course, to Jonathan Coppess, Nick Paulson, and Gary Schnitkey, all agricultural economists here on the Urbana-Champaign campus at the University of Illinois, and Jim Balch, who's behind the scenes, making sure that everything runs very smoothly, as it always does, and he'll get this site really quickly so that you can review it again. We thank you for joining us on this FarmDoc Daily Webinar, Changes to the Commodity and Crop Insurance Programs in the One Big Beautiful Bill Act. Extension's Todd Gleason. Have a good day.